Okay, we've got a detailed analysis report in today. It's titled Golden Opportunity, Why I'm Buying the MSTR Dip Today.
Bold title?
It is. And the material presents a really powerful, very focused bullish case from MicroStrategy. It's priced around $164 in the report.
And the core argument?
It's arguing this recent dip is a huge buying opportunity. It's driven by, three things: a valuation disconnect from its Bitcoin treasury, this leveraged exposure to a potential Bitcoin supercycle, and, well, just extremely strong analyst conviction. There's a $705 price target in here.
That is a compelling narrative. I mean, it's high conviction, and that leverage component it's exciting. But for the kind of audience this is aimed at, we need to immediately focus on strengthening the argument's robustness.
The logical structure.
Exactly. We need to make sure the confidence you build on the upside isn't just, easily eroded by some obvious counterpoints that an expert reader is going to spot right away.
Absolutely. The material is strong, no doubt, but we're looking to make it, well, unassailable. Let's start with the cornerstone of the whole thesis: the valuation disconnect.
Okay, so while the report does a really effective job highlighting that valuation disconnect from the Bitcoin holdings, the argument would be so much stronger if it detailed why the market should still care about MicroStrategy's core legacy software business.
I see that gap immediately. The report focuses so heavily on the PE ratio, that 7.66 number.
Right.
And it frames it as the market just, quote, valuing MSTR like a legacy software company. The implication is that this PE is way too low.
But it doesn't prove it.
No. By completely ignoring the revenue streams, the stability, even the growth potential of that actual software business, the report leaves itself vulnerable.
That's the weakness right there. The analysis just assumes the core business is neutral or maybe even a plus, but it doesn't give us any reason to believe that. I mean, what if the software segment is declining rapidly?
Then the discount might be completely justified.
Exactly. If it's a drag on the business, then that core bullish claim of buying dollars for 50 cents, it loses its punch. Because maybe that discount is actually necessary to offset a decay in the core operations.
So the suggestion isn't to write a whole deep dive on enterprise software. That would completely derail the main crypto thesis.
Of course not.
It's more about preemptively neutralizing that main counter-argument, the one that justifies the current PE ratio. We just need to stabilize the floor under the whole valuation argument.
Precisely. Just dedicate a brief, high-level segment, a couple of sentences is probably enough, to the stability of that core business.
And what does that do?
It shows mastery. It shows intellectual honesty. It reassures the reader that the analyst hasn't just looked at the Bitcoin balance sheet, but actually understands the entire corporate structure. It proves MSTR isn't just some slowly imploding shell company that happens to own a lot of Bitcoin.
Okay, so how can the writer integrate that quickly and powerfully without, adding a bunch of fluff?
Well, instead of just stating MSTR is priced like a legacy software company, you could include one specific metric to prove it's stable. For instance, just cite its recent quarterly revenue trend.
So you could just note that software revenue has been flat or, maybe slightly positive year over year.
That's all it takes to confirm stability, but we can take it a step further.
How so?
You could use that stability to actually prove the undervaluation claim. Introduce a simple thought experiment for the reader.
Okay.
What if we, just for a moment, assign 0 value to the Bitcoin holdings? What would the remaining valuation imply for just the core software business? Then you compare that multiple against its sector peers.
So you're suggesting we briefly assign a theoretical enterprise multiple to that business to set a baseline. What kind of industry multiple would even be a fair reference point there?
You don't even have to commit to a specific number. The report just needs to demonstrate the logic. For example, if the math suggests the software division is trading at, say, 0.5 times its annual recurring revenue.
Which is very low.
Very low. The analyst could simply state that this is significantly lower than even the slowest growing peers in the sector, which might trade at 1.5x to 2x revenue. That comparison instantly provides a robust, two-sided foundation for the valuation claim. It makes that 50-cent dollar analogy way more defensible.
That's a really strategic move. It transforms a potential weakness, the unexplained PE ratio, into objective proof of analytical rigor. Okay, so we've solidified the floor, but the ceiling, that's defined by the incredible leverage involved here.
Right.
Let's talk about how the report manages that explosive upside and the risk that comes right along with it.
Building on that point, yeah. The entire thesis is driven by this leverage factor. When Bitcoin moves 1%, MSTR often moves 2 to 3%.
It's the whole point.
It is. So that means the report needs a much more robust acknowledgement and a structural neutralization of the associated volatility and downside risk.
The current framing, citing the analyst's $705 target and comparing MSTR to a call option with no expiration date, it's undeniably engaging. It makes the bull case sound irresistible.
It does. It's great writing.
But that optimistic framing completely neglects the reality that if Bitcoin retreats or even just stalls, MSTR's downside is going to be just as, if not more, exaggerated.
And that's the risk, isn't it? Focusing only on that 300% plus upside might make an expert audience feel like you're glossing over the risk management part.
It could make the whole assessment seem insufficiently rigorous, especially for a highly leveraged asset like this. A professional reader expects the analyst to have already thought through the downside structure.
So we need more than just some boilerplate disclaimer at the end. The goal is to integrate the risk discussion in a way that actually strengthens the bullish case.
How does that work?
By showing the analyst has done the heavy lifting, you introduce a dedicated, integrated segment that addresses the volatility risk head-on, and then you immediately pivot back to the thesis's strength by referencing the strong support structure. It shows intellectual honesty.
You address the elephant in the room, the amplified downside, and then show why your thesis can still stand up to it.
Exactly. It dramatically strengthens the credibility of the whole forecast.
The framing is so key here. How do we pose that risk acknowledgement constructively without just scaring the reader?
You can explicitly pose the counter-question to the bullish drivers, something like, what market conditions or macroeconomic shifts could specifically invalidate the Bitcoin supercycle thesis and that 705 price target?
So you ask the hard questions yourself.
You ask the hard questions, which gives you permission to confidently answer them. And a much better approach than just listing abstract risks is to tie the risk management directly to the price action that's already in the technicals.
Tying the risk back to a tangible threshold. That's where the analysis becomes really specialized, really useful.
Precisely. The report notes that the technical support at $160 is critical. The suggestion is to quantify the theoretical Bitcoin price level that would need to be tested for MSTR to decisively break below that $160 support.
Ah, I see. So you give the reader a clear, actionable risk management threshold. It shifts the discussion from this abstract fear to quantified management.
It transforms the weakness into a high-utility feature of the report.
The framing on that is so critical. If we provide that calculated Bitcoin threshold, what does that instantly communicate to a sophisticated investor that just saying, set a stop loss at $159 doesn't?
It communicates that the analyst understands the mechanics of the leverage. A sophisticated investor doesn't just want to know where to sell, they want to know why that selling point matters in relation to the underlying asset they're really betting on.
Which is Bitcoin.
Right. By calculating the implied BTC breakdown price, the report provides a predictive tool. It says, look, we will only breach 160 if Bitcoin itself drops to X, which we assess as low probability given the current market structure. That's the difference between simple risk management and deep analytical justification.
That's a highly specialized metric that only this kind of deep dive analysis can provide. Okay, now let's turn to the structure and flow of the analysis report itself. It's almost like they built this incredible engine, but forgot to install the timing belt.
That's an excellent way to put it.
We know why it should move, but not really when.
Exactly. And to optimize that flow and maximize the impact, the technical breakdown, the part that discusses the double bottom formation and the rejection of lower prices, it should be tightly interwoven with the fundamental golden opportunity drivers.
Not presented as this structurally separate confirmation at the end.
Yes. Right now, the material presents these three powerful fundamental drivers: valuation, supercycle, analyst confidence. And then it abruptly shifts to the technicals. The double bottom, the key levels at $160 and $180.
That structural separation is really inefficient, isn't it? The technical argument feels like an add-on.
It does. It lacks a clear fundamental catalyst. And, on the other side, the fundamental arguments lack that decisive timing validation. The reader is left knowing why MSTR is attractive, but the connection to why today is the golden opportunity is a little shaky. They have to piece it together themselves.
So the technical shouldn't just be the receipt at the end of the report. They should be the actual starting gun.
That's the mindset shift.
We need to position the technical analysis not just to confirm the price action, but as the specific trigger that operationalizes the whole thesis. It's what bridges the gap between why the stock is undervalued fundamentally and why now is the moment to accumulate technically.
That's it, exactly. The technical analysis is the timing mechanism that validates the fundamental claim. So you refine the narrative link between driver number one, the valuation disconnect, and the technicals.
Okay, how?
You could frame the $150 support test and that subsequent double bottom as the precise historical moment when the stock price briefly fell below a demonstrable metric of its intrinsic value.
A value that's validated by its Bitcoin holdings.
Right. So the technical pattern isn't just some squiggly line on a chart. It's proof that the stock briefly became a measurable value play. You're using technical data to prove a fundamental claim, not just confirm a movement.
That makes so much sense. And we can sharpen the strategy segment using that integrated approach too. Right now, the strategy is a bit general. I am treating this sub 170 zone as an accumulation zone.
We can sharpen that. You integrate the $180 resistance level directly into the strategy.
Because clearing $180 is explicitly cited as what's necessary to open the path to $200. That $180 level is the first clear hurdle.
Yes. So instead of just generally accumulating, you refine the strategy. Accumulation below $170 is a strategic move in anticipation of the confirmed momentum shift needed to clear 180. You frame the accumulation as preemptive positioning for the technical breakout trigger.
It makes the short-term forecast more strategic, less assumptive. It connects the chart points directly to the actionable decisions.
The integration should feel seamless. The technicals become the clock for the fundamental time bomb.
This detailed approach really transforms the analysis. I mean, the material that was submitted is already strong, but these adjustments will elevate it from a compelling narrative to a highly defensible investment thesis.
Genuinely so. These are the kinds of adjustments that transform a strong bullish report into one that caters directly to a sophisticated audience. It rigorously defines the value, the timing, and the risk management plan.